I think the biggest thing for people to remember is it's not, again, don't wait for what might happen next year. Don't wait for what might happen in 6 months. Like really work with what it is right now, because I think that there's the fear and greed index, right? That people always
Mhm.
follow. And people are fearful, right? And if you look around, like everyone is afraid and unknowing of what's going on, but these are the markets that, greatness is made.
Alrighty, folks, since I have been back from my Asia trip, something seems to have changed with my real estate investing friends. I am having more and more friends look to do cash out refis now, given that rates are relatively stable. They're telling me they are building this dry powder because they want to start making more and more disrespectful offers. We are seeing inventory grow, days on market grow, and there is an increasing expectations that 2026 will be game changing with deregulation and the like. So I don't know what's going on, but when I have my friends doing 10, 15 cash out refis all at the same time to raise dry powder, that's signal. That's not noise. That is a signal. So, Jonathan, I'm curious, in your book of business, are you seeing, medium and larger players doing cash out refis now to raise dry powder?
Absolutely. And they're actually, I think, if anything, kind of taking the advice of what we told them maybe 2 years ago, right? And the reason I say that is because we've been kind of preaching the same thing over the last 2, 3 years. Like, hey, make the offers now, right? Make it on the current market, because you don't know what's going to happen in the future. So they're going to get better deals now than they will, they would have gotten, in the future if rates are lower. So they're finally coming back and being like, okay, I have 10 properties, 15 properties that are all basically very, very low leverage.
Yeah,
It's like worth
50
200, 300
50%.
grand
Yeah,
or
50%
less.
leverage. Yeah, or less. Yeah.
Yeah, yeah, or less, right? They have maybe a 3.5% or a 5% on like a $20,000 note remaining, right? On
Mhm.
their $200,000 property, right? And we don't have to take cash out all the way, but we can take it out to maybe 60% or 70% and still be like, even if it's a little higher in the rate, which it is like mid sixes, like, that kind of range, right? They are taking that over doing a second, because if you do a blended rate average on the second loan, it ends up being higher. So they're saying, okay, let's take it all the way out there, because if an opportunity strikes, and I've heard it already happen, like I want to have the cash to make the deal happen, cash, right?
Right.
Because if I need to make a disrespectful offer and I need to move quickly, nothing moves faster than cash. So
Yep.
they're storing all this, and we just had a client do this. They're storing four, five, $700,000 of cash to make disrespectful offers, to buy make an offer at like 300 grand, let's say, when it's worth 400 or
Yep.
500, and say, I'm going to buy this, but I'm going to close tomorrow, or I'm going to close next week with cash. And then what they'll do is they'll fix it up, and then 3 months later come back and say, okay, I want to refinance, pull some money out, not like all of it, but some of it, as if it was like a new purchase loan, and just leave like 50%, 60% leverage in there, in the actual property, and take maybe 40% out or whatever on the cash out scenario, so they can recoup a little bit of what they put in, and then do the same thing again next time. But the only way that they can do that and make those aggressive moves is the cash aspect, because anytime you bring up a loan, I think in a like disrespectful offer, your offer is diminished, like the effective ability of your offer to be accepted is diminished, because now you have contingencies, now you have this, now you have that. Versus if you stack all your cash right now from properties you have equity from, you can go in aggressively and say, no, I'm ready. Here's the proof of funds. I'm ready to close tomorrow or next week or this week. You know, just transfer me the title. Like, let's get an escrow company. We don't even need agents. Just do this and get it off the books, and then I'm gonna buy it cash. And then that's how you, I think, make the strongest disrespectful offer to a client, or to a
No,
seller.
this is exactly what my friends are doing. And again, I've been talking to them for a while, but they've all kind of pivoted to it's basically time to get greedy, is what they're telling me. So they're using the rate environment, which has basically been flat for roughly 2 years. They're seeing inventory build in their buy box or their area, They are seeing demand, given all this chaos with tariffs and all this other stuff, rip away demand. And they're like, strike, baby. Write disrespectful offers 25, 30% below. And you're absolutely right. That final point about cash, that's the wrinkle. Because again, if you write a disrespectful offer that goes, oh, I got to go get a loan and appraisal, blah, 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 much less likely to say yes. But if you say cash and we can close in 10 days, very different conversation, right? If you're the
Yeah.
seller.
And also, I encourage, obviously listeners to keep in mind that when you like, everyone wants to make a disrespectful offer, but nobody thinks about it if in the perspective of the seller, right? And what I
Correct.
encourage a lot of
Correct.
clients to do is, if you're going to make a disrespectful offer, make sure that you're making it not just to make the offer and saying, oh, I'm good, but I'm going to do a 15% down and I need a 20-day contingency, and you
Blah, blah,
can't.
blah, blah. Yeah.
It's, yeah, it's very hard for the seller to look at that and say and take that offer seriously, right? Unless they are very distressed, right? That's a different story. But
Yeah.
if they are not distressed and they're looking at an offer and then they're comparing it to an offer that might be just a little above what you're asking or saying that you want to offer at, and this offer includes cash, or this offer includes like a shorter loan contingency or whatnot, like they're going to pick that offer over your disrespectful offer, right? And a lot of people that are writing disrespectful offers, I think, miss the point of, let me look at it from the seller's point of view, and is this an offer that is reasonable actually for the seller? Can I back this up? Am I just taking the market value and cutting 30% and saying I want to make the disrespectful offer? Or are there actual reasons why I'm making this disrespectful offer that I can go back to the seller and say, hey, this, and this, but also here's the good news. I'm ready to close this week,
Yeah.
right, with cash. And I
Yeah.
think that's kind of where you stack up the cash.
I think this is very telling. Again, it's funny. I just saw Ken McElroy. He's talking about buying $500 million in property. Obviously, a totally different game. But I'm starting to see the big players get active now, which is, you talk about signal and noise. This is signal, right? They're people want to step into the game when demand is low and supply is rising. This is where the money is made. And if the best way to get that deal done is cash, it makes total sense. Again, I got a buddy that's doing 10 cash out refis right now. He's probably going to put away 7 figures, and he's going to deploy it. I don't know what it'll be, 5, 6, 7 different deals. This is it. It is definitely something going on. So I think other investors out there should look at their portfolio and just ask the question. Does this make sense for you and your plans or not? Maybe it doesn't, and that's okay.
Yeah, obviously, if you ask us, we're willing to lose business by telling you no, right? So
Right.
I've told so many clients, like, no, this doesn't make sense. Don't do it. Don't do that. This might make sense. Look at this. But other than that, we'll tell, if it doesn't make sense, like, at least us, Dustin and I will tell you, hey, it doesn't make sense, because we're not, thankfully, we're not ones that are like desperately crying and grasping for straws for business, because we've blessed. But because of that, it gives us the luxury of being able to tell clients, like, hey, this isn't a good deal. I don't want to push you in this deal. This is not what you want to do, and kind of
Right.
advise against something, right? um but yeah, I mean, this is, if anything, this is the time, because you mentioned it a little earlier because we talked off camera, but I looked at rates, the rate sheet that I issued out to a client, a quote sheet that I issued out to a client a day ago, and then I looked at it 2 years ago, same client, and it was the exact same, maybe off by an eighth.
Right.
And he was like, I heard rates are falling. Can you give me an updated quote? And I looked at it and I was like, you waited 2 years for the market to be exactly the same. And in that 2 year period, all these other people have made so many big moves, right?
Yeah.
With the cash that they have. So, like, that's why you never know what's going to happen in the future. But 2 years ago versus now, exact same rates, maybe off by an eighth.
Yeah, I love that. I love that. You also have a new lending partner that's allowing you to do DSCR loans at 15%. What the hell is that? That's crazy.
Yeah, yeah, it is crazy, and it's 1 to 4 units, 15% down, DSCR. It has to debt cover at least at one. But the benefit of this program, I think, and this is not something I want to like push to clients and say this is what you have to do, because you're minimizing your cash. But The only reason I would suggest it is if you are doing, let's say it's good enough to live in right now and it's in
Mm,
tenants to move in. However, you need some cash and you know you're going to need cash to kind of do work on the property and do some
right.
value add.
Yep.
Because if that's the case, then obviously later on you want to refinance it to a better value. Great. So that's when I would recommend you come in and put 15% down, a 30-year fixed, right? So you have that elongated time period. Maybe take a 1 year prepay or no prepay, right? And do the extra work in terms of the cash, put it in to the property, make it nice, and then build that equity in to the actual property valuation itself. And then a year later, after it's a little stabilized, refinance into a 30-year fixed loan at a lower rate, hopefully somewhere in the sixes or the fives. But that's kind of the scenario that I'm gonna encourage listeners go into is this is not the program where if you only have 15% down to use the full 15% down to buy a property, right? And try
Yeah.
to cash flow that thing. Because people forget the number, like the expenses and of like fixing a property if something breaks, if plumbing breaks, if termites infest the house. Like people forget that there's money included in these things, right? Like you have to pay bills that are expenses beyond just the mortgage payment. So
Yeah.
if you only have 15% down, this is not the program for you, right? I'm probably going to tell you no, save more money
Yeah.
because this is not
Good.
you can't put 15% down and then have nothing left. So if you have more than 15% down, but you're only doing this as a strategy to do value add, like one of my clients is doing it right now, 30-year fixed, we just locked him at like 799 with a 1 year prepay. It's not I mean, obviously the rate's high, but it's not that high given
Not
what
high.
you're
Not
putting down and
it's
have
lower than I expected. It's lower than I expected for
yeah,
a 15% down program.
30-year fixed, one
Yeah.
year prepay. He's going to do some work to it, and then after a year, after it's stabilized, we're going
Yeah.
to refinance into a better loan.
There you go.
Yeah,
This is
yeah,
a good program for you're doing a bird slowly. I like the fact you don't have any time pressure, right? You're not on a 1 year clock or something. You can take your time. Maybe you've got, like you said, a 4 unit. You're doing one at a time, but it also allows you to have certainty, right? That 30-year
hmm
fixed is powerful, even though it's a little
yeah,
bit higher than maybe you would expect. But you
yeah,
also have bank statement loans that are rocking and rolling. What's that all about?
yeah. Bank statement, alternative like documentation, profit and loss type program. Again, 15% down to buy the property. But this is another one of those examples. I'm not going to push. If you don't have all 50, only 15%, don't use that to buy the property. But if you have more than 15%, you're trying to do value add. This is another alternative that allows for rates to be slightly lower. So in
Mm,
this example, if that was 799 with a 1 year prepay, in this example, it's more like 75 with a 2 year prepay, right? So
okay.
it gives you a little bit more of like a cash flow ability, right? And it just made up that word, but cash flow ability aspect of the actual property to be able to help carry kind of the difference in the
Hmm.
payment until you're able to stabilize further and then refinance out. But this is kind of the same scenario. You have the cash 15% down to buy it, 30-year fixed. You have a long time horizon, so you're not in a rush. Um, a good example actually just came to mind. I had a client that bought something in Beverly Hills, and it's on market now. But he was very smart about it. He bought it syndicated, right, with a bunch of people, but bought it with a $3 million loan. He bought it for he was under contract for six, but he put 3 million down because
Hmm.
of the fair plan and that's a max $3 million the max. So he did that, and then he also instead of taking a bridge loan on that deal because he knew he was going to be done with the property in like a year. But instead of taking a bridge loan on that, I had advised him, same thing I'm advising everybody, just do a 30-year fix so you're not in a rush to get this
Yep.
thing sold. Now he sped through the construction, has it on market for like 17 mil, right? But he's not in a rush to sell. His
Right.
carrying cost is so low because the loan, like he bought it for six, super disrespectful offer, won the deal, is gonna eventually make a lot of money on this deal, which is a great success. But because he was able to kind of mitigate the risk by having that loan amount be kind of smaller and the rate be lower, but a 30-year fixed time horizon, there is zero rush for him
No
to have to
rush.
take an offer that's bad. which is the problem with a lot of other developers in like Hollywood
Yes.
and Beverly Hills right now, is they're taking bad offers because they can't afford to carry the loan.
No, I love that. Again, the 30-year fix is just it decompresses the situation. It's a certain payment. There's no balloon. There's no, additional collateral required. I also love the fact that people are writing disrespectful offers in Beverly Hills. I figure if you can do it there, you can do it anywhere. So pretty
I
cool.
mean, 3 million, 6 million to 17 is a pretty big, it's a
Yeah, I
pretty
don't know.
big
I don't
gap.
know what yeah, I don't know what it costs to all the make ready, but even if it was $4 million, that's still a healthy profit.
Yeah, absolutely, absolutely. So, I mean, people are doing this, and I think the biggest thing for people to remember is it's not, again, don't wait for what might happen next year. Don't wait for what might happen in 6 months. Like, really work with what it is right now, because I think that there's the fear and greed index, right, that people always
Hmm.
follow, and people are fearful. Right. And if you look around, like everyone is afraid and unknowing of what's going on, but these are the markets that greatness is made. Convoy started in this market, right? We started in this market, and we're at where we're at because we put in the work when market was bad. So now I feel like that's the same thing for every investor across the board. This is the market to do the work. This is the market to make those disrespectful offers. Have the cash ready. Have be able to deploy something, and not just go in with kind of a weak disrespectful offer, but come in as a strong player, like a big fish, and come in and be able to kind of make the offer, write it, close it, and then refinance out of it later. But the only way you can do that is by staying ready.
Yeah. Yeah, I
Yeah.
love it. Jonathan, if somebody wanted to reach out and get a plan going, what and how do they do that?
Go to convoyhomeloans.com and let us know you came from ORaaT.
Yeah, if you go to the site Convoy Home Loans, there's a little blue button on the left. Does it say apply now? I think it is.
Yep, exactly.
Yeah, click on that button. Then down at the bottom of the screen, it gives you how'd you hear about us. Just put ORaaT right there, and that is important because you will get Jonathan right here or his partner Dustin. Take care, buddy.
Thank you.
Mhm.